Good afternoon, everyone. Happy Wednesday. Thank you so much for joining another Barometer webcast. I'm Pamela Hastings, Relationship Manager here at Barometer Capital. We have a special evening lined up for you this afternoon, or rather afternoon lined up for you today. Joining us is, of course, David Burrows, Chief Investment Strategist and President here at Barometer. And we have Diana Avador, our Head of Trading, who will be speaking about correlations and what she's seeing, eyes on the trading desk and market flows. So we are happy to have Diana Avador join us today. And with that, I turn the conversation over to David Burrows. And of course, at the end of our conversation with David and Diana this afternoon, we will get to your questions. I've seen a few come through my email already, phastings@barometercapital.ca. And if you would like, you can also hit me up on the chat via Zoom. So we'll speak to those questions a little bit later, but with that, I turn the conversation over to David. Happy Wednesday, David.
Thanks, Pam. Nice to see your face, and it's nice to see Diana on the call today as well. What I thought we'd do today, it's been a bit of a bumpy week. It's been a few bumpy weeks for technology. There's been lots of discussion around inflation and Fed policy and whether they're preparing to take the punch bowl away. So some discussion of that, and so obviously some Fed minutes came out today, so we can talk a little bit about that. But why don't we get going? We always like to start from the top and talk about our baseline premises. In the end of the day, I think that when people hire a manager, they're not hiring them to be in every asset class, in every sector, in every theme. Our job is to have tools to try to figure out where the big picture is going and where the flows are going, to focus in areas of the market that people care about most. And for most people who know us, they know we believe we've been a structural bull market for stocks since we broke out in 2013. This is the US stock market. And important, when markets go sideways for a long period of time, like 1966 and 1982, when they eventually break out, it generally means you've begun a new long-term bull market. And markets certainly don't move in sync, but money ultimately goes to where it is treated the best. And so funds are always flowing from group to group, asset class to asset class, from geographic region to geographic region. And our job is to understand where we have the wind at our back and where we have the wind in our faces. So we've been of the belief that the US stock market's been in a bull market since 2013. And certainly there have been pullbacks along the way, but we know these can go on for a very long time. And we have to remain open to the fact that things can go a lot further than you think they can. We also have had the view that we have been going through a structural bottoming in interest rates. This is the yield on the 10-year bond, much like we did in the late 1940s into the early 1950s. And once rates reversed, it meant that what worked in markets was really quite different than what worked during falling rates leading up to that period. And we've lived a long time in falling rates. There's a lot of embedded views as to how we make money investing. And I guess I would say you really have to question the beliefs that you have, because a lot of them have been built between 1981 and 2021, 40 years, which is going to require a little bit of rejigging. We also believe we've gone through a structural bottom in commodity prices, which have been in a bear market for a very long time, certainly since 2007. And frankly, you could go all the way back to the early 1980s when you really got a significant top in commodity prices. So this could be meaningful as well, because again, when this group turns, it turns for a long time, and it generally has some meaning. So the S&P has been working its way higher. This is a chart back to last May. We rallied through the summer. We corrected in September, October, as we often do. And then the market just trended. And we have been in this channel ever since. And we certainly have been at the top end of the channel. We've been at the bottom end of the channel. The pullbacks have been fairly shallow. It's been a fairly consistent move higher. And certainly since November, led by groups that would be more sort of value driven. If we take a look at the Nasdaq, Nasdaq certainly led off the lows last spring, but really started to run into some headwinds in the early part of winter and certainly from February until now. Technology in general has had a difficult time. The Nasdaq 100, the biggest tech stocks in the market, certainly have underperformed the S&P. Doesn't tell the whole story because sort of concept technology, the mid-cap companies without much by way of earnings have really had a rough go, down 50 to 70%. There's probably some meaning in that as well. So if we take a look at the Nasdaq and just look at relative price performance, this is relative strength versus the S&P. Actually, we are at the lowest relative performance versus the S&P in a year. Certainly it has meant that investors probably needed to focus in some other places. And again, we're always looking for what the message of the market is. It tends to be that long-term growth stocks where you're paying for many years worth of earnings will underperform if we think there's going to be a re-acceleration in the economy. And there are those concept tech stocks. This is the ARKK ETF. It's Cathie Wood's Innovation ETF. Lots of really interesting companies that at some point I'm sure will be wonderful companies to own, but in the near term, the market is trying to buy, investors are trying to buy companies that will see substantial upticks in earnings, not in 5 years or 7 years, but this year and next year, which is why the economically sensitive companies have been leading, and money has sort of moved away from this group, at least for now. Commodity prices, as we talked about, bear market since 2008. A number of months ago came out of that bear market and working their way higher, continued to behave quite well. And now the TLT, which is the long end of the US bond market, we've been putting this up in virtually every one of our webcasts. This was the peak in bond prices, or at least a recent peak in bond prices going back to March of last year, where the 10-year was at 50 basis points. Of course, they sold off. They rallied a little bit through March and April and have been weakening again. So it's actually one place just to stop for a moment and say, so what does this all mean together? Well, certainly, bond funds are really underperforming. I read this morning that if you took the top 20 bond funds in the US, every single one of them is down money on the year. But interestingly, if you thought that a bond manager was concerned about the bond market, you would think that they would reduce their term to maturity or the duration of their portfolio. And you can see actually that the average bond fund, investment grade bond fund, still has quite long duration. In other words, they're invested in relatively long-term bonds. And that poses a great risk because a 1% move higher in rates from here effectively would wipe out 8 years of income returns by way of yield because yields are so low. So risk reward, not very good here, and certainly money has been moving away. So let's start actually off the top today with our breadth models because we want to talk about what's happening under the surface. It's a very interesting market. And if we look at it at first blush, what we can see is the breadth models that we run for Canada, for US stocks, and for global equities have seen some deterioration in breadth. So what does that mean? We measure for each of these universes the percent of companies within each of these universes that are in long-term uptrends. And what we know is when you see weakness in breadth, it tends to mean there is some deterioration under the surface. Now, it can be broad-based deterioration. Sometimes it's more targeted. So we're going to talk a little bit about that. But in the very near term, our short-term indicators have been weakening. Our longer-term indicators have been weakening. So we've done a lot of digging under the surface to try and understand where the risks lie and what we need to be more cautious of. And I have some thoughts on that. So I've asked Diana Avigdor to jump on the line today. She's our head of trading. When we do our morning meeting each morning, we start out with Diana. We talk about sort of near-term issues, things that are affecting markets today, and what we can take away from them. And I thought maybe she could give us a little bit of color, both on how the market is reacting to this inflation data and maybe what we can take away from it, and then how it might be impacting certain sectors. Diana, are you there?
Yeah, I'm here. Can you hear me?
We can hear you.
Perfect. Thank you very much. It's nice to be here. Thanks for everyone coming. So hot off the press, just measuring the temperature of the patient on a daily basis. The biggest story last week has been the CPI that was released. And the CPI was much hotter than expected. And the markets fighting to know whether inflation is here to stay or is transitory. And for now, it's absorbing news very, very well. So in that chart, what you're seeing is the circle is where the CPI, the day that the CPI was actually reported. And you can see that the higher than expected CPI impacted the dollar by pushing the dollar up. That's the first one on the left. But then give it a couple of days and the dollars come right back to where it was before. And then if you look to the right of it, you see the 10-year treasury yield. That also jumped up on the CPI because it was better than expected. So perhaps it's inflationary. But then it moderated in the last couple of days. The rates moderated the last couple of days. And then finally, the bottom chart is gold. Gold sold off on the day of the better than expected CPI. And then it rallied right back and took out that day's high and is right now actually higher than there. So the point of this chart showing you this is that the market right now does believe the Fed that inflation is transitory for now. And even if it's not transitory, it will take quite a while for this to seep through. There is about $5 billion in savings out there that needs to be used up from pent-up demand before we start actually needing to do other stuff. So the market right now believes that inflation is transitory and we are in a reflation environment rather than an inflation environment. Right. And I would just add a caveat that equities are a hedge for inflation, at least till about inflation is about 5%, generally speaking. So we're not there by any means, but if we were going to that direction, we would be in a pretty good hedge position by being in equities. And Dave showed the bond chart, a really high duration there would really impact an interest rate sensitive asset on the fixed income side. So markets right now absorbing these news. There could have been a situation where a better, higher than expected CPI or any other inflationary economic number would take the market down. But in this case, the market is absorbing these news very, very well.
Yeah, I think that's an important point because in the early 50s, when rates started to rise, there was reflation, meaning asset prices started to rise. It wasn't that there was inflation. In fact, it took about 10 years for there to be sort of sustainable inflation. Inflation ebbed and flows over the first 10 years, but it was more came in bits and pieces. And we really have come to the view that if the market believed that inflation was really getting away on the Fed, then they would expect the Fed at some point in the next short while would have to stomp on the market by reducing liquidity and raising rates. And that was the knee-jerk reaction on the CPI news. But the market digested that news and said, okay, but the Fed says we're going to focus on employment and we can let inflation run a little bit hot. And so clearly the market came to the view that it doesn't believe that we're going to get sharp rise in rates. Now, sharp rise in rates would choke off the stock market, could choke off the move in commodities, all of these things. But I think Diana's point is a good one. It's often not what the news is, but it's the way the market reacts to the news that's most important. And Diana, this was an interesting chart. You put this up in the morning meeting the other day, and I thought maybe you just talk a little bit about it, because when we see weakness in breadth, it could be broad-based or it could be fairly targeted. And what do you think that this chart means?
Yeah, so this chart is a correlation between factors. And what that means is over the last few years, actually since the great financial crisis, and while we were going through the generational lows in rates, there was kind of a one-way trade in factors. High growth worked, technology was a darling for many, many years. What we have right now is sectors that are acting independently of each other and stocks within sectors that are acting independently of each other. In other words, when correlations are down, it allows a portfolio manager or an investor, anyone, to actually pick and choose and offer a real diversification in the portfolio, because not everything is moving in the same direction. And so what you're seeing here, and when we get to showing some sector work, Dave, and we can show that, the breadth readings in certain sectors are way different than in other sectors.
Well,
And
why don't I jump in? Why don't I jump in there and I'll
yeah,
throw a couple of those up. So here's the XLF, which of course is the financials sector, and this is the XLF coming out of the range it had been in since 2007. It's been marching sort of smartly higher. It's a group that is relatively underowned in the market. It's as when the group broke out back in February, it had the smallest number of buy recommendations from analysts of any sector on the street. Now you can understand that because it had been 14 years since the group had made a new high. The materials group, materials group is marching higher since last fall smartly, and that's broad based across metals and gold and silver and forest products and chemicals. There's the gold sector. This is a very long-term picture of the gold sector, but this is the rally from sort of 2000 through 2011, went out of favor, a long consolidation, made a new high, consolidated from last fall, and broke out over the last 2 weeks. There's the Newmont chart that made the first new weekly closing high, going all the way back to 1984. So the value sectors performing really well. And on the other side, growth, this is the RPG, the S&P 500 growth index, obviously relatively considerably weaker. And, if we take semiconductors as an example, and this has been a favorite group of ours for many years, this is relative price strength of the equal weight semiconductor index versus, what's been happening in the S&P. So certainly have and have not groups. This is software, semiconductors, and the Nasdaq breaking long-term trend. And of course, on the other side, we have, value kind of performing well. So Diana, what can we take away from the flows? You sent me these charts over earlier. I thought we were talking about.
Yeah. And so I just wanted to show that, further to what you're saying. So flows into global technology funds have been very high, as you can see, over time. And they've started to moderate. They're not down, but they're moderated. If you have the next ones I showed you in financials and industrial, there's financials. That's a different looking chart. There's been an industrials. There you are. There's been visibly higher than normal flows into industrials and financials. And, there's been no decline in technology. My point is saying that, and there's the total, $645 billion of flows over the last 26 weeks. That's $5 billion of flows per day. This is one of the best quarters, actually. This started since October, quarter and a half, in many, many months, in many, many years, rather. My point is in pointing out that there's been big flows in financials, materials, and energy, and so forth, but not the equivalent decline in technology. It relates to that correlation chart that we showed earlier. And correlation is how things mesh together. It means that there is something to do in different things at different times. And technology is a big sector in the S&P. It's good that it doesn't have real negative outflows because that would take the indices down. But we're seeing slowly reallocation of assets into this regrowth or reflation or reopening environment. Technology has been a darling for many years, so it got a lot of flow. And the other sectors have been very underinvested. So that's being rebalanced right now, and you can see that in the flows.
Yeah, I think that's really interesting. And when we look under the surface back at our breadth work, we can see that, okay, when we look at by sector, the percent of stocks that are trading above their 50-day moving averages, we can see that only 29% of technology companies are trading above their sort of intermediate term moving average. Consumer discretionary is 44. The other end of the spectrum, materials and financials, over 90% of stocks trading above their 50-day moving average. That's really good breadth. We aren't seeing any deterioration there. And when we look at our breadth work, okay, now what we're looking at here is we take 41 industry groups and we take each one, take the total number of securities in each group and plot the percent of companies within that group that are in rising price trends, long-term uptrends. We plot the ones in capital letters that are seeing continued improvement in breadth. And I just want to point this out. It includes base metals, machinery, food, oil service, and precious metals and steel. All of these are reflationary sectors. And when we look at the group that are technology related, semiconductors, internet, biotech, software, computers, they have been seeing deteriorating breadth. However, they're getting pretty sold out. That's like, for instance, in this column, semiconductors have only between 16 and 20% of the stocks in the sector in uptrends or on point and figure buy signals. So what that means is they are starting to get sold out. So it doesn't mean that the weakness there is taking down the rest of the market. It means there is money rotating from group to group. So if we believe we're in a reflationary cycle, the things that are working are the things that should be working. And that tells us that this is more like reallocation than money actually leaving the stock market. And, you know, nothing tells the story better than this. Diana, right? This is the flows into value after years of money leaving the value sectors.
Yeah.
And when we look at the performance of the Russell 1000 Value Index versus the Russell 1000 Growth Index, the last time we saw a reversal in this fortune was in 2000. And that was a significant change in character of the market as to what worked for the next few years. So this might be very early in this process. And so Diana, keep showing us this data.
Yeah.
Because it's really great. So Diana, thanks so much for jumping on.
My pleasure.
I just want to run through a little bit of relevant data that we think continues to influence markets. You know, certainly last week we talked about the fact that we have seen a big uptick. This was data from the 12th in CPI. And so CPI obviously had a good sized jump that included increases in prices for hotels and motels, car and truck rentals, used cars and trucks. Amazing. I had a car dealer phone yesterday to suggest that my daughter's 4-year-old Honda could be traded in for a brand new Honda for an extra $10 a month because the price for used cars is so high right now. He could get out of a 4-year-old car into a brand new car. Quite remarkable. Now that's before we really have had a significant pickup in restaurant dining and travel. And we talked before about CPI being particularly strong. The one group that has been not as strong has been travel and leisure. And we're certainly seeing a pickup there. So I think that's why we continue to see the jobless claims go down. And the number of unfilled jobs last week was 8 million jobs in the US, which is a record. And from all around, what I continue to hear is we're having a hard time getting people to work. I love this quote from this morning. The employee shortage is so bad that long hair freaky people can now apply. That applies to some of our partners, perhaps. But certainly there is a little bit of labor inflation out there. So our job is to do 3 basic things. We need to use the tools that we have to really identify where the money is going next and focus in those areas. We call that market leadership. Groups that are seeing net inflows of capital, groups where breadth is improving, groups where we have the wind at our back. We watch very carefully for signs of change, old leadership receding or new leadership emerging. And that certainly gave us some clear signaling through the course of 2020 and continues today. And then, of course, if breadth weakens across the board, then we got to be prepared to get defensive. So at this point, while we see some weakness in some of the breadth data, it's very targeted in specific groups. They happen to be groups that we are light in. And so I'm pretty happy with the positioning. Does it make sense that the financials are behaving as well as they are? Well, you can see that bank stocks tend to perform well. This is S&P banks during periods where we are seeing sort of inflationary periods. And certainly, you know, that looks to be the case. And there's the financials breaking out of a range they've been in for 14 years. I would say that's more likely the beginning of something than the end. And we also know that rallies in commodities tend to go in sync with headline US inflation, and really there's no surprise there. The last thing I want to touch on is that in times of rising rates or reflation, it tends to be, from an income perspective, the very best place to focus in are dividend growth stocks. So not necessarily the highest dividend payers, but the ones with the greatest rate of dividend growth. And this cohort continues to perform well, trading above virtually all the moving averages and performing well relative to the S&P. So let's take that all down to brass tacks. We're in a reflationary period. We need to focus in the groups that benefit from this kind of environment and where we can see price supports our view. So we are seeing strength in financials, and not just big banks and regional banks, but insurance companies, asset managers, capital markets, brokers. We have a 39% weight across the firm in financials. We think there's excellent risk reward. We think we're going to get great dividend growth, and that's versus an index weight of 11.9%. Energy is 13%, continues to behave well. Materials is 13%. You can see continues to rise as a percent of the portfolio. We've got a slight overweight position in industrials, and you can see we continue to have very low weights in things that are not economically sensitive, like healthcare, telecom, consumer staples, technology coming in really only at 3%. I can't remember the last time that was the case. So I think there are some wonderful technology companies, and there are some great themes to be invested in at some point. Right now, the market isn't rewarding it, so we'll stand aside and let that ship get righted. Things that I think help us to believe that this market's still on a pretty good footing. We just come out of a quarter with the best earnings beat in history. US financial conditions are currently the easiest in record, meaning there's lots of liquidity in the market. The old saying is, don't fight the Fed. The number of companies announcing buybacks continues to rise. These are quarter by quarter. And certainly we've had a giant acceleration in share buybacks in the market. Having just come out of the quarterly earnings period, corporations are now back sort of at full throttle buying their shares in the market because there is a significant cash on balance sheets. And the dividend increases are coming sort of fast and furious, a very different picture than what we saw last year in the second quarter, where we had lots of companies suspending dividends, decreasing their dividend. None of those in this quarter. So we think market's in pretty good shape. We always follow what the bond market has to say. The corporate bond market, the spreads being demanded by bond investors are as low as they've been in a long time, meaning that bond investors don't feel there's a lot of credit risk in the market. And while volatility moved a little higher this week, we continue to make lower highs each time volatility spikes. And so at this point, that's not a major cause for concern either. We will get very defensive if our themes start to get hit. And certainly we can see corrections at any time. You know, May, June often can be a bumpy period. But at the same time, given the fact that the Fed is printing money almost with abandon, we think sitting in cash is not a good idea when asset prices are inflating. So for now, we continue down the path with the same sector weights, keep focusing in the same groups. We look for any sign of change. If things start to weaken, we will get more defensive. But for now, we think we're in a pretty good spot. So with that, Pam, if there are any questions, certainly happy to answer them.
Dave, of course. Thank you so much. And thank you, Diana, for joining us. We always like to see you and hear what you are seeing directly on the trading desk.
Thank you.
Today's sharp sell-off in miners, do you believe this was just a response to correct a rally, or is it something else, David?
Look, a bull market is characterized by steady advances and the odd short, sharp decline. And certainly, you know, there was a big sell-off today in cryptocurrencies this morning. Just for those that follow us, we had already reduced our Bitcoin exposure to zero over the last few weeks. But that did put a little jolt into sort of more aggressive investors. But no, it does absolutely nothing to the thesis they pulled back a few percent, and they've been on a tear, obviously, since November. Not a major concern there.
Dave, next question. What is the most interesting thing that you feel is happening in today's market?
Look, I think that it's inevitable when new leadership takes over. After a little while, there would be lots of people try to talk them down and say that they're expensive relative to where they have been over the last few years. And very often, it's because they're stuck looking at the valuations they had during a bear market. And when a theme gets going, it can go for a long, long time. Remember, commodities have been out of favor for over 10 years. Banks have been out of favor for 14 years. There is a lot of money that will slowly rotate, and there's a ton of people who are behind the curve. What we see is very often when the market opens down in the morning, the strength that comes back are these key leadership themes. So I think that is very interesting. And at the same time, Diana and I were talking today, what we've been seeing is sort of tech for sale at the end of each day, which is people cleaning up orders that they've been working on through the course of the day. So I think that's probably the most interesting thing. This battle between the Fed believing that the inflation is transitory and that they don't have to do something active now is an interesting tension between that and the market saying, don't let inflation get out of hand. And so far, the market seems to be remaining orderly, and ultimately the balance of power is that people are believing that they shouldn't fight the Fed.
Thanks, David. Any thoughts on the Russell 2000?
Yeah, certainly the mid-cap stocks have had a difficult time. So let's just pull that up quickly. So if we take the IWM, this is the Russell 2000. We can move that back to sort of the beginning of the rally. And let's just draw a little trend line. And this is by no means overly scientific, but what you can see is that we recently have broken trend that has been in place really since the lows in March. Now, if we were to take the value Russell 2000 value index, it's actually acting much better. But similar, you've got weak Nasdaq and stronger S&P, and definitely stronger value index. So I think the most important thing is sort of what's happening. There's a small cap growth. This is small cap value. Small cap value behaving much better. So it really is coming down more to the factor of value versus growth, or cyclical versus secular growth. That is the most important distinction right now in the market.
Thanks so much, Dave. Going back to cryptocurrency, I know we were early investors in it as a thesis. Do you believe the recent pullback is a result of governments feeling threatened by its momentum? Would you go back into crypto if you felt it was appropriate?
Yeah, look, we talked over the past few weeks, and in our meeting last Wednesday, talked about the fact that this looked like a topping formation. And so we had exited in our macro portfolio. Actually, we exited our crypto right back in here in the middle of April, because we were seeing some indicators deteriorate a little bit. And I think we had about a 1% weight left in a few portfolios at the end of last week, which is now gone. And certainly this is a big shot. So it's interesting. It traded, Bitcoin traded all the way down to $29,000. Closed today basically around the 200-day moving average. We'll see whether it can repair itself. It's not like this group hasn't had significant pullbacks along the way. If we look at it this way, there have been some jolting pullbacks, and in the scheme of things, this is not such a big deal. But we'll wait and see if it redevelops before we put any money back.
And finally, pivoting from Bitcoin to high-paying dividend ETFs, Dave, what would you recommend in US dollars?
Well, you know what I've said to people is if someone's looking for high dividends, this is the SPHD, which is a high dividend paying ETF. Let's see if I can switch gears here just for a moment. No, I can't do that. This SPHD relative to RDVY, which is more of a lower dividend but higher dividend growth ETF, is way outperforming. No, this is the high from February of 2020. This is where this ETF is today. Now compare that to SPHD, effectively where we were in February. So high dividend paying stocks do well when the bond market's doing well. If bond prices are falling and rates are going up and high dividend stocks don't tend to grow their dividend a lot, they look less attractive, just like a long-term bond looks less attractive. So I would encourage people, and certainly in our income strategy, we are entirely focused in dividend growth stocks because we believe this is a group that's going to outperform. If this is the early stage of a rising rate cycle, dividend growth stocks could outperform for like the next 10 years. And so I would be more inclined to focus in dividend growth.
Well, thanks so much, Dave. That concludes our questions for today. I will leave you, as always, with the final word.
Look, you know, we get into May, June, we're always a little bit cautious. I can say that our exposures are down somewhat. Certainly in our macro portfolio, we are actually well less than 100% net long. We are taking advantage of some of the weakness. We've been short the Nasdaq and short the Russell 2000, certainly short the bond market, and short some of the momentum indicators momentum ETFs. This is the MTUM, because frankly, the MTUM gets reconstituted at the end of May, and a whole bunch of stuff that's in there now will no longer qualify as momentum, and so there's going to be a significant shift there. So we're doing things around the edges like that, but our core themes, I think, you know, look strong, and we'll watch to see that they continue to perform the way they should, given what we think we know. But it's onward, and I think we're just really relatively very early stages in this reflation theme, and notwithstanding very short-term corrections, is going to go on a really long time. So thanks, Pam. Thanks for today. And thanks everyone for joining us.
Thanks so much, everyone. Have a great evening. We'll see you next Wednesday, same time, same place. Talk to you soon.